Hello, welcome back. I'm Sal Martone from Treasury Partners Portfolio Management Team, and I'm here with Dan Beniak. We're going to be doing a quick fixed income update. Dan, 10-year yields at 4.5% currently, effectively flat year to date. What are you seeing out there?
That really says it all, Sal. It's become somewhat less volatile out there on a day-to-day basis. It can still bounce within 5 or 10 basis points, but we're back around that 4.5% mark on long end 10-year U.S. Treasuries, and it feels like it's a little sticky around there. On the shorter end, we're bouncing around the 4% rate on 2-year Treasuries, and that's actually come up a little bit versus what we saw as we were entering May. We had gotten as low as 360, 365 at the end of April as the market was assuming a more aggressive Fed that would cut rates by 3 or 4 times before the end of the year. Now, instead, the market assumes that the Fed's really just going to cut between 1 and 2 times before the end of 2025. So that's gone up accordingly. But as we know, it's still lower than the Fed funds rate, which means that we expect that the Fed is going to cut and the market is pricing it in accordingly, right, Sal?
Yeah, definitely consistent with Fed communications. Expect a number of cuts for the next year or so.
And obviously, what happens in treasury markets directly feeds into what we see happening in corporate bond markets. That has also steadied somewhat, and we've also seen corporate credit spreads, which had gone a little wider in response to market anxiety about market tariffs, have come in considerably, so they've stabilized. But we're still at the point where 3 to 5 year A-rated or higher corps, you can get 4.25 to 4.5% yields on those, and you can get upwards of 5% still on that 7 to 10 year plus range, perfectly good A-rated corporates. So that's still looking attractive to us for clients who don't have tax liabilities. For clients who do have tax liabilities, we're still looking at the muni bond market, which remains very interesting. That is also stabilized to some extent. Remember, in previous videos, we've shared with viewers the fact that we'd seen a technical imbalance in the market, high supply being met with somewhat lower demand had caused yields to spike considerably. That's really stabilized to the point where we see 4.5% plus tax-free yields still available on the long end, but we're not really seeing them spiking on a day-to-day basis the same way we had been in previous months. It's been a little bit sticky. We're still happily putting as many of those bonds as we can into client accounts where it makes sense. But we're entering the summer season, Sal. That typically means that investor demand tends to go up. Usually, as we head into the summer holiday season, supply also tends to moderate a little bit. So perhaps that won't be around for much longer, but until it is, we'll be taking advantage of it as best we can.
Great. Thanks, Dan.
Thank you, and we'll see you again next month.